Welcome back to another episode of the Modern Multifamily Podcast. I'm your host, Mike Wolber, and I was very excited to sit down with Alex Roudi today. He is the CEO and founder of Interwest Capital Group, a multifamily and real estate focused ownership group based in San Diego. In this episode, we started at the very beginning, Alex's career where he graduated college and started a very successful cleaning franchise business, serving more than 25,000 customers globally, and how he went from that and his first successful exit into building Interwest. In this episode, we dig into the assets they invest in, their thesis for investing, how and why they provide so much value to their investors, and what has Alex and the rest of the Interwest team excited as they look forward to the next 2 to 4 years. This conversation was fun and fast-paced and very insightful, and I hope you enjoyed this conversation with Alex Roudi, CEO and founder of Interwest Capital Group. Let's get into it. Alex, thank you a ton for joining me today on Modern Multifamily.
Oh, you're welcome. It's my pleasure to be here with you.
I am super excited to spend some time with you. You are the CEO at Interwest, a really exciting owner down in Southern California. And I think a great place to start today, Alex, would be a little bit about your life journey and how you actually found yourself in the chair you're in today. So why don't we go back in time a little bit and talk
Okay.
through how you found yourself in this really important seat in the industry?
Okay. Well, I'm going to maybe take us back through, when I was much younger and I was just graduating from grad school. I went to Purdue for undergrad, UC Berkeley for graduate school. I did engineering and was all geared up to go back to my birth country, which was Iran, to work in construction business and so forth. Um, as luck would have had it, we had a huge event happen back in Iran, and there was a revolution. The government basically took everything that many business people had, and nationalized them. And so there was nothing really for me to get back to. And I ended up staying in the Bay Area in San Francisco, and worked at a company designing nuclear power plants. Did that for a few years. And then ultimately, through a series of events, I basically wanted to run my own show and have something that I could do. I didn't really have much capital, and couldn't really do anything like real estate, which was more along the lines of my education. So I started a service company. I started a company called Coverall Cleaning Concepts, and it was a company doing providing services, cleaning services to environments such as offices, industrial facilities, healthcare facilities, etc., but with a twist. And the twist was that we didn't really have any direct employees providing the services. We would set people up into their own franchise units, and those folks would then provide the service with their families. And for them, it was a way to own their own business, but not taking the risk of quitting their daytime job.
This is Mike. I'm just jumping in to share an observation as I'm listening back to this recording. It's so fascinating to get into the mind of a founder and an owner. You're hearing a couple really unique things here from Alex. One, he wanted to build a great business without having the natural overhead of a ton of employees, something that a lot of owners think about as well in real estate. Secondly, he was constantly trying to find ways to bring unique and measurable value to his partners and to his investors. You're going to hear more of this throughout the founder story today as Alex talks about building Interwest. And I just want to make sure you're thinking about all of the connection points from these early days in his career back in the 90s. Let's get back into it.
So with us, they would pick a package, a franchise package, and the package was included a starting customer base. And based on that, they would pay a different franchise fee. But since they were making that investment, and with the help of our team in the regional offices where they were located, they would get the training and the know-how. They would then provide the services in the evenings, usually with their families. And this was an additional source of income, which they could use, putting their kid to college and for different purposes. Using this system then enabled us to have a highly motivated workforce to go and provide these services to end users, which were these, buildings. And in an industry where you had a very high turnover of customers, typically was over 50% a year. So a typical, cleaning company, if you would, they would lose 1 out of 2 accounts that they had, but another company would pick it up. With our system, that kind of got dwindled down to around 18%. So we could go to a region, set up shop, and really grow, right out of that. And so that was a pretty winning formula. It was a win-win-win situation. It was also a way for us to deliver a high level of service to the customer on a consistent basis. And because we were dealing with all these franchise units, the management of that for us was much easier than if they were all direct employees of ours. So the company expanded, and I grew that company to about 66 offices. We had offices in the US in different cities, and then in a number of different international markets, Asia, South America, Europe, and Africa. And so it became a pretty interesting platform. We had about 4,500 franchise units and about 23,000 customers. So it became an attractive platform for a couple of private equities to buy. And so I sold the company in 1998. I came out, I was pretty young and didn't really want to, hang up my hat and retire. Had 2 very young, basically daughters at the time. They were very, very young. And so, did some investments here and there. And then eventually, after I would say 4 or 5 years, I got into, I wanted to start something in real estate. And I wanted to do it in a way, again, with a little twist. And the twist here was putting together a team and then focusing on buying distressed debt opportunities.
So can we go back in time really quick, just so I can connect the dots for everyone listening?
Yeah.
So you built a big, beautiful cleaning business.
Yes.
That sounds super efficient. You didn't have to be the actual manager of the employees you franchised. You created opportunities for families to go own a business and control their own destiny through being backed by a brand and having access to infrastructure. And you turned this into a global entity. You sold it to private equity. You had an outcome in 1998. You stayed on for a few years. How do you go from that to then deciding that you want to start running towards ownership in real estate? Those feel very different, but I'm sure they connect in your mind.
That's good. Well, so what happened was, obviously through that exit, I then had a fair amount of capital that I could invest. And so with that in hand, I started dabbling into, I wanted to create another, platform, another entity, another business, and wasn't really sure what I wanted to do. I was attracted to some of the technology startups and so forth. And so I started dabbling into that. And as I was doing that, I had a couple of successes, but a number of, no success and failures. And so it was a very volatile type of undertaking. And it was something that, wasn't really a way for me to build another company, if you would. So I decided, what can I do? And as I indicated to you, my education was in construction. It was basically civil engineering and then structural engineering. And so with that, I was always attracted to real estate. But up to that point, I would be an investor in some partnerships of real estate. So I decided, hey, let's think of something that we could do here. And in doing so, I didn't want to just do something vanilla, and got attracted to owning a company or owning an asset through acquiring the debt on that asset. And this asset usually was something that either had some kind of an issue, either a upside down capital structure, or it needed some additional capital infusion. So that's what I did. I hired some people that were that had experience in this, and I was the provider of the capital. I had a line of credit with Goldman Sachs at the time that would enable us to buy these assets, if you would, without the need of outside investors. So we did that operation for about 5 years. So we got to 2008. We had a really good track record. We had done some really good acquisitions and divestitures. So in 2008, our line of credit went away because of the financial downturn. Now all of a sudden there were a huge number of opportunities, but we didn't really have any capital support. And this business is very capital intensive, as you can imagine. And so at that time, we opened ourselves to bringing in outside investors. And our first few investors were all institutions. These were big private equity firms that had experience in investing in real estate. And so our expertise was to find the right opportunity. And because I was really deploying, and even to this day, a fair amount of the equity in every acquisition, personally, our focus always is on reducing the downside risk. So we want to make sure that we have a right business plan with the right assumptions that would that could put us into a really good return environment, but also assumptions that if things don't go as planned as what we have in our business plan, on the downside, we're not going to lose our equity. And so this was essentially our motto. And so first we had institutional investors. So all of our reporting came to really address what an institution likes to see: full transparency and full reporting on a frequent basis. We then opened ourselves also to private investors. So we started private investors and family offices. And so from 2008 to 12, there were a lot of great deals that we did that were primarily driven from buying distressed debt from big institutions and big banks. And then from 2012 onward, when that distress environment had gone away, we became really focused on doing multifamily acquisitions from a value add orientation or core plus orientation. And as time went by, at the beginning, when we started in business, we were doing multifamily, hospitality, office, retail, and industrial, all 5 sectors. And then as things evolved from 2012 onwards, we became really just focused on multifamily. And in that regard, We do this business in a number of different markets throughout the Smile States. What we look for is a very long range of economic drivers in these markets. We want to go into markets that are growing, that the wages are growing, so that it would give us ability to do what we need to do to provide an attractive community to our renters, and would allow us to increase the rents on an annual basis as our costs increase. And so we are in these markets, and we started operating in one or two of the markets. We also are focused in doing some ground up development, but our majority of our business is really buying existing opportunities. Now, what has happened since 2000 and since about 24 months ago is, with the sudden increase in interest rates, you have now created an place where you have huge amounts of distress. You have from 2021 to 2024, interest rates were low. People were buying a lot of these assets with making very optimistic assumptions and taking high leverage and floating rate loans. And with that, all of a sudden now you're in an environment where interest rates are high, rents have not grown as people had expected them to grow, and now you have a situation where they cannot service the loans. And so there is definitely very interesting opportunities that are cropping up. So at this juncture, we are really focused on buying new or newish type of projects in the markets that we understand, and really then be focused in executing our business plans in each one of these acquisitions. We just recently, as I mentioned, we are in multifamily, and as multifamily owners and investors, we deal in just your market rate conventional multifamily. We also have student properties. We also had age restricted properties. So we covers different sectors. We recently exited one of our student properties, which was next to Texas A&M. We had that asset actually for 11 years. Our normal hold period is 3 to 5 years, but sometimes, depending on circumstances, we can keep an asset longer term if majority of our investors want that to happen. In this case, we exited after a long time, realized 24% IRR, which over a long time is a pretty big accomplishment. And we essentially had a 5.2x on our equity, which is pretty cool. Of course, the time element was there, so we could turn the equity around, but the returns were fantastic. So,
and Alex, can I ask you a quick question about your investor profile?
Yeah.
So you mentioned that like early days when you had some capital shortcomings around 2008, that you shifted to opening up to some institutional
Correct.
investors. Have you since, as you've evolved your investor profile, like opened up like limited partners to be able to come in, or what does the current investor profile look like? I'm just curious if normal folks like me are participating in these deals, or if it's still really the big dogs that you're partnering with, because that really is interesting to my audience.
Good point. No, we started with having institutions, which was actually very good for us, because with institutions, you're more or less, you become more disciplined. You become more focused on how you report, how you manage, how you execute. So we really became an institutional shop in that sense. But then in 2011 or 2010, 2011, we also opened to, and private investors and family offices. So today we have around something a little over 300 private investors and family offices. Our goal is to increase that number to to well over 1,000. And so we hope that we have um, people that are interested to really come and learn more about us and hopefully become part of our investor family. So that's our hope. Yes, you're looking
Gosh,
for
that's awesome.
additional investment.
Um, keep
Yeah,
keep going. I was just really curious on that because I've helped a few people place investments through this show, and I know folks are always interested, especially high net worth folks or folks that have experienced liquidity for the first time, who has maybe sold a
great.
business. The tax benefits, let alone the long term cash benefits of real estate, are mysterious to a lot of people until you experience it. So I'm just really excited to be hearing this from you today.
That's cool. So currently, for example, we have two deals under contract. And I have to back up and also mention that we are very selective. As I mentioned, we really want to control the downside. So our assumptions are very conservative. And because of that, we may look at over 100 potential acquisitions and we may just do one.
Mhm.
So in a 1 year time frame, we may just do 5, 6, 7 deals. We are not a shop where you do 20, 30 deals. So we are selective as to what we do, and we do those well. So currently we have, for example, two deals that we have under contract. One of them is a student property. That is a bigger deal. It's about 670 beds in a university that is growing in a really tight area where your supply is very, very limited, which is another factor we look for, is how limited is the supply coming into the market, because with a lot of supply, you can't really grow your rents. And so that one is very promising. We're almost done with our due diligence on that one. There is another one that we have that is a smaller property. This one is just your conventional market rate multifamily. And this one is, again, in a very interesting, attractive market, has an in-place loan. It's a new development that was developed and was 2024 was finished. The developers have hit some snags with some of their other operations, and they're basically in a position that they have to exit this. We already own in this market very successfully, and we were able to get this deal on a basis where it's lower than what you can replace it today, which is another thing we look for always. But because we are assuming this loan and the way we are buying this, our cash on cash return on this one is a little over 8%, and our hold period is about, I think, 5 years or so, and our exit, again, we're looking for something around, in this case, around 15% IRR, but most of it is coming in on a regular basis. Our distributions are quarterly,
Mhm.
so we are always do that with our investors, and we're hoping that as we get into more of an easing environment with the interest rates, that more deals can start happening, because there's been a big gap between bid and ask, and we're getting to a place where that gap is narrowing down, which would increase the frequency of these deals. But that's what's going on with us,
It's
and
cool.
every day is a new day.
It seems like it. I probably am closer to the technology markets than the real estate markets, just based on how I've spent the last, decade plus of my career. And I'm definitely seeing the M&A market in tech open up right now. You're seeing more investment happening. There's a lot of dry powder, as people say. And I'm hearing on the ownership side that like transaction volume is going to really start to heat up. I'm curious, Alex, when you're finding these really awesome deals, Are these deals on the market, or are these being kind of coming to you from your network since you've been in the game for so long?
It's mostly coming from the network.
Great.
Um, but I also have to say that in almost all cases, there is an intermediary involved, but the deal may have been under contract by someone else before, dropped out of contract, and then the deal has been sitting on the shelf. And because we are active in that market or for any other reason, they bring it to us. We really go through it, and there always has to be a story for us in order to execute an acquisition. And the story can be one where there is some inherent value that is not apparent to maybe another buyer. There could be a situation where we can act quickly and we can get a better pricing and better execution. So there's always has to be something, or there is a big upside potential if we were to deploy X amount of capital into the deal by making it, better and nicer and so forth, and more appealing in the market. So once we have that story and we feel good about our basis, and our basis currently needs to be always below what you can build that project for today, and sometimes by a big margin. And so that gives us a protection on the downside. And we always capitalize our deals in a conservative way. We don't go with a high leverage, floating rate type of execution. We usually bring in agency financing, 60-65% debt to purchase price ratio, 1.345, sometimes close to 2x on debt service coverage ratio. So always try to do things in a very thoughtful and conservative way.
For sure, I hear that. I'm curious, Alex. You mentioned being close to 300 investors today. Desire to have that number more than triple in the future. If you kind of were to hypothesize 5 years out from now, what's Interwest going to look like as you continue to build? The market's changing in front of our eyes.
Yes.
Sounds like you've seen goodness as you've gotten the business focused more on asset classes versus being too wide in terms of what you'd said yes to. What's next for you and for your business?
Good question. So, no, first of all, I think the experience of us being in a buying position from 2008 to 12 was very, very important. It kind of ingrained something in our DNA, because we saw what people or what groups had done in form of how they were buying or how they were building, and the type of very optimistic assumptions that were made by them, which then caused them to go into a downfall when things just changed all of a sudden. So we always have that discipline around us. So as now we have, I would say the next 2 years is ripe period for us to buy. The last 3 years was a good time for us to sell because of where the prices were. But the next 2 to 3 years are really good times for us to buy. And with that, to answer your question, where we see definitely having over 1,000 investors, definitely having being able to capitalize, maybe in about 3 years, within the next 3 years, probably around 10,000 to 11,000 units of acquisition, and just going through a nice growth period. We have all of our, all of our infrastructure in place in the markets that we are active in, because we already own in those markets. We already have experience in those markets, and so this is a way for us now to accumulate more interesting assets in those markets. And the type of assets that we are attracted to today, they are newer in vintage, and they're basically, they're just well built. We don't want to get into a situation where you have physical depreciation towards the end of the physical life. So it's our focus is newer products, but interesting situational opportunities, and in the markets that we understand. That's really where we are going. And our track record, Mike, has been very really attractive. I think we had a very big accounting firm that did an audit of our returns up to current times, and we have shown returns of net IRR to our investors in the somewhere close to 30% IRR and about 2.4, 2.5x on equity. This is on assets that we have exited. So we've shown a good track record. We want to continue doing that, and that's just continue building on our strength.
It's awesome. I really like that. I'm curious. Last question for me is there a size and scale where you actually start to think about pulling management in-house, or will you continue to be a pure owner, really a master of the market, and then working with the best management companies out there to make sure that the assets that you own are being managed correctly? There definitely seems to be an inflection point where owners start to look at the expense of management and whether or not it makes sense to pull it in-house.
That's a good.
And the reason I ask is that the first business you started, you were able to own a business without having to directly manage all of these employees.
Right.
And that would certainly change the dynamic here. But I'm curious what your take is on pulling management in-house versus leaving it outsourced.
Okay. So today, as you indicated, we and from the beginning of time, we have been dealing with third-party management companies. These are big management companies, strong management companies in the region that they operate. Usually, they are companies that we've had experience with in the past, and we basically what we are really good at is asset management. So what we do is we hire these third-party management companies. We get them involved from the onset, even before we have a deal under contract, on a project that we are attracted to, and so that we develop the business plan together. So there is a buy-in from them on the business plan, and then once we close on the transaction, we really manage them in a very efficient but close manner to make sure that we are on target with our plan, that we are hitting the thresholds, hitting the targets at the timeline that we had devised. So we are very good in that. We are very good in managing third-party management companies. And the reason we deal with third-party management companies is because we are spread in different markets, and we also have learned through experience that when you own and manage at yourself, you become a lot more close-minded to best practices that maybe another management company can deploy that is not yours. And so you're only then going to be biased towards having your own management company doing it. And as I mentioned to you before, one lesson that I learned from my building the cleaning company Coverall in the past was that when you manage a lot of employees, when you have a management company, you're managing a lot of employees, especially if they're in different markets, it becomes very complicated. Mm-hmm. And you won't be as effective as if you have very localized managers. In our case, in the past was franchisees. Today, there are these property management companies. And for us to be good managers of them, to be good asset managers of them. So I don't really foresee us doing that. It's not is not something that we are thriving to do. And I would say you need a scale in order to do it in a given market. And that scale would be several thousand units in that one market for you to be able to really have redundancy in the number of employees, etc. But even then, if you're dealing with really good management companies that are good in that region, they have the infrastructure and they have the backup and redundancies that you're looking for.
It's awesome, Alex. Well, I'm definitely walking away from this conversation cheering like crazy for you and for your business. And a little bit about the audience that listens to this show. It's really going to bias towards a lot of multifamily marketers and a lot of folks that sell technology into real estate that aspire or already actively invest in real estate through ownership groups, syndications, etc. As we look to close today, Alex, I just want to kind of give you the red carpet. Anything you want to close with, people that would want to talk to you about managing one of your properties or investing, anything
Sure,
you want to end with before we wrap up today?
sure. So number one, I encourage everyone to maybe check us online. Just go to our website, interwestcapital.com, and also encourage folks to contact me directly, and if they want to learn more about the company, more about how investment in, as in how it would be like to become an investor in our company, we would be very happy to share all of that. And they can contact me by just my first name, Alex, at the name of the company, interwestcapital.com. So I would love to see and hear more from your listeners, and hopefully we can again do this at some time in the very near future.
Absolutely. Alex, you were an amazing guest. A huge thank you to our mutual friend, Peter, for making today's conversation happen. And I hope to see you in person very soon.
Thank you. Take care. Have a great day.